Imagine for a second that you are sitting on a corporate board of directors. Or, if that feels just a bit too abstract, just think about your own retirement account.
Right, yeah.
You've got, let's say, $50 million, or maybe it's just your life savings, and you need someone to manage it. You meet a guy who posted a 20% return last year.
Sounds great on paper.
Exactly.
Yeah.
The presentation is slick, the numbers are absolutely phenomenal, and you feel like an absolute genius when you hand over the check. But 6 months later, the market shifts just a tiny bit and that manager's fund completely implodes.
Yeah, just completely falls apart.
Half your money is gone in a week. And as you sit there staring at the screen, you realize a terrifying truth. You didn't actually hire a brilliant investor. You hired a gambler who got lucky.
And you couldn't tell the difference before the check cleared. It happens every single day at every level of finance.
It's wild.
It really is. Separating a lucky streak from repeatable structural skill is arguably the most difficult diagnostic challenge in the entire financial ecosystem.
And that is exactly what we are unpacking for you today on this deep dive. We are taking a highly specific, incredibly rigorous text reading 25 from the Schweizer notes for the 2024 CFA Level 3 exam, and we are going to extract the absolute core of it.
Yeah, the real meat of the reading.
Right, because this isn't just about picking stocks. This is the gold standard playbook for investment manager selection.
Yeah.
It's how the highest level institutional allocators evaluate, select, and monitor the people who manage their money.
Because whether you are that pension board member responsible for billions or, you're simply trying to figure out which mutual fund to put in your 401k, the underlying math and the psychology, they're identical. You need a framework to avoid financial disaster.
So we're going to dive deep into due diligence, statistical traps, performance metrics, complex fee structures, all of it. And we really have to start at the absolute foundation.
The ground floor.
Yeah. Before you can hand over that $50 million, you have to know how to even begin looking. We have to move from the emotional desire of, I want my money to grow, to the cold, hard mechanics of due diligence.
Right. And the CFA text defines due diligence very specifically. It is the analysis and investigation in support of an investment decision. But, and this is key, it puts a massive flashing warning label on one specific aspect.
Which is what?
Your due diligence must emphasize the sources and the reasons behind actual past returns. You cannot, under any circumstances, just look at the returns themselves.
Okay, let's stop right there. Why? I mean, if a manager is handing me a spreadsheet that shows they made 20% a year for 5 straight years, why shouldn't I just say, great, keep doing that?
Because you're flying blind.
Why is looking only at the final number blinding me, though?
Well, let's look at it through an analogy. Think about hiring an executive chef for a world-class restaurant. If you only look at the final numbers, their Michelin stars or, their Yelp reviews, that's just historical data. It tells you they made good food in the past.
Right. They have a good track record.
Exactly. But what if they achieved those 5-star reviews because they had a sous chef who actually did all the heavy lifting and that sous chef recently quit? Or what if they relied on a highly specific, rare ingredient that suddenly becomes unavailable?
Okay, so the environment changes.
Precisely. Financial markets are not static kitchens. They are highly volatile, constantly adaptive environments. The ultimate goal of due diligence is to evaluate the probability, the statistical likelihood of this manager repeatedly earning sufficient returns in the future.
Using the exact same investment process.
Yes, even when the market environment inevitably shifts.
So if a manager made that 20% last year by betting their entire portfolio on, say, a single biotech stock that just happened to get FDA approval, their return is amazing.
Unbelievable return.
But their process is essentially buying lottery tickets.
And the probability of them repeatedly finding one miraculous biotech stock year after year is statistically near zero.
Wait.
The due diligence process exists entirely to filter out those lottery winners from the mechanics who have an actual repeatable engine. The text breaks this down into 3 main components, defining the manager universe, quantitative analysis, and qualitative analysis.
The universe part I get.
Yeah.
You can't analyze every manager on Earth, so you filter it down. You say, I only want to look at large cap value managers in Europe.
Exactly. You build a sandbox.
But it's this split between quantitative and qualitative that I really want to dig into.
Well, the quantitative analysis is the math. It's the historical track record, the volatility, the standard deviation, the actual returns. But the qualitative analysis, that is the journey. It's the decision-making framework, the risk controls, the team dynamics.
So going back to our chef, the quantitative is reading the Yelp reviews.
Right.
The qualitative is actually standing in their kitchen on a Friday night during a massive dinner rush and watching how they handle a grease fire.
That analogy works perfectly, but let's push it even further. It's like watching how they handle the grease fire, sure, but also examining who buys their vegetables, how they treat their staff, and whether their recipes are written down or just, stored in their head.
Oh, because if it's just in their head, it's not repeatable if they leave.
Exactly. And the text emphasizes this concept of alpha decay.
Wait, alpha decay. Alpha being the excess return a manager generates above the market benchmark, right?
Yep, that's alpha.
How does an excess return decay?
Think of it like half-life in physics. If a manager's alpha relies on something highly fragile, say, they use a high-frequency trading algorithm that capitalizes on microsecond pricing errors, their alpha decays instantly if the market adapts.
Because someone else figures it out.
Right. If a competitor builds a faster fiber optic cable, that manager's past returns instantly become meaningless. Their edge is gone. So if the process isn't qualitatively sound, their quantitative track record is just a mirage.
So the quantitative tells you they survived the last environment, but the qualitative tells you if they are structurally equipped to survive the next one.
Exactly. But here is a massive problem. Even with a perfect due diligence framework, human beings are the ones running it.
Yeah, we're messy.
Committees, analysts, boards, we are the ones looking at this data and making the final hiring or firing decisions. And human beings are structurally wired to make massive statistical errors, especially when our jobs are on the line.
Which brings up a really fascinating psychological dilemma from the text. When we evaluate a manager, we have to start with a baseline assumption. The text calls this the null hypothesis.
Right, the null hypothesis.
And in manager selection, the null hypothesis is that the manager has absolutely no skill. They add zero value.
It's essentially guilty of being average until proven skilled. We do not assume you have an edge. You have to prove it to us mathematically.
And when human beings try to measure that proof, we fall into two specific traps, type I and type 2 errors. Let's break these down, because the career psychology here is just wild.
It really is.
A type I error, a false positive, is when we reject the null hypothesis when it is actually true.
In plain English, you hire a manager or you keep a manager
Yeah.
who actually does not have skill. You thought they were a genius, but they were actually just a gambler.
And then we have the type 2 error, the false negative. This is when we do not reject the null hypothesis when it's actually false, meaning we look at a manager who actually does have skill, but we think they don't, so we fire them, or we pass on hiring them.
Right. We thought they were bad, but they were actually good.
Now, mathematically, both of these are errors. Both of them cost your portfolio money. But the text explicitly states that in the real world of finance, type I errors receive a vastly disproportionate amount of attention from boards and committees.
A huge amount, yes.
But why is that? I mean, if missing out on a great manager costs me potential millions and hiring a bad manager costs me millions, a loss is a loss, right?
Economically, yes, absolutely. Psychologically and professionally, absolutely not. Oh yeah, a type I error is an error of commission. It is a highly visible, active choice that you made. Let's put you in that boardroom. You sign the paperwork to hire a specific manager. You allocate $50 million to them.
Okay, my name's on the check.
When they subsequently lose 20% of that money because they actually lack skill, your signature is on that loss. Every single board meeting, your name is attached to that bleeding red line on the spreadsheet.
Oh, I see. It's the sports draft equivalent of trading up to draft a highly touted quarterback in the first round, and he turns out to be a total bust.
Yes, perfect analogy.
Every single time he throws an interception on national television, the camera pans up to the general manager's suite. You made the active choice to bring him in. The failure is public.
Exactly. Everyone sees you fail. But a type 2 error is an error of omission. It is just a missed opportunity. If you look at a brilliant new manager, decide you aren't sure if they have enough skill, and you pass on them.
And then they go on to generate massive returns for a rival firm.
Right. But no one really sees that. It does not show up as a line item loss on your quarterly statement.
Right. The camera never pans to the general manager who passed on a Hall of Famer in the 6th round because literally every other team passed on him too.
Exactly. You don't get fired for missing the hidden gem, but you absolutely get fired for paying top dollar for the high-profile disaster.
And if you connect this to institutional behavior, it completely explains why the entire financial system skews toward extreme conservatism. Board members are terrified of career risk.
Terrified.
The psychological burden of the error of commission is so heavy that committees will demand an almost impossible amount of proof before hiring someone.
And this is exactly the point. To avoid the highly visible explosion of a type I error, institutions suffer 1,000 invisible cuts from type 2 errors.
They never capture the truly high returns because they are just too afraid to act without absolute certainty.
Yeah, the invisible bleed of institutional finance.
So if these committees are terrified of making a type I error, terrified of hiring a fraud, they can't just take a manager's word for it. They need a mechanical check to force honesty. They need, like, a lie detector test.
And in finance, that lie detector test is called style analysis. This is where we verify if the manager's actual behavior matches their marketing brochure.
The text highlights two ways to do this: returns-based style analysis, or RBSA, and holdings-based style analysis, or HBSA. Let's start with RBSA, because the math behind this is really clever. How does looking only at returns tell me what a manager is actually doing?
Imagine a scatter plot graph. You take the manager's monthly returns for the last 5 years, and you plot them against the monthly returns of various major indexes, say the S&P 500, a small-cap tech index, and maybe a bond index.
Okay.
We run a statistical regression, which is essentially a mathematical way to see how closely two lines move together.
Okay, so if the small-cap tech index goes up 5% in January, and my manager's portfolio goes up exactly 5% in January,
Right.
and then the tech index drops 3% in February, and my manager drops exactly 3%.
The regression will tell you that regardless of what the manager claims they are doing, their risk exposure is heavily tied to small-cap tech. We don't need to see the individual stocks they own. The stream of their returns reveals their true style.
It sounds to me like looking at the shadow of a car on a wall to try and guess its make and model. You can probably tell the difference between a pickup truck and a sports car just by the outline, even if you can't see the car itself.
The shadow analogy works, but let's take it a step further. It's like looking at the shadow of a car while it's driving 100 miles an hour.
Oh, man.
Yeah, you can see the broad shape. You know it's a sports car, but you have absolutely no idea if the engine is overheating or if the tires are completely bald. RBSA is relatively easy to do because return data is public, but the text warns that it is relatively imprecise. You sacrifice deep accuracy for ease of calculation.
Which brings us to the alternative holdings-based style analysis, HBSA. This is where we stop looking at the shadow and we actually open the hood of the car.
Right. HBSA looks at the actual underlying holdings of the portfolio at a specific point in time. It categorizes every single stock, bond, or derivative the manager owns.
It's like an audit.
Exactly. It evaluates the size, the valuation, the dividend yield of every individual piece. It is vastly more precise.
Okay, genuine question then. If HBSA is so much more precise, why would anyone ever use RBSA? I mean, if I have $50 million on the line, I want to look under the hood. Why look at the shadow if you have the option to open the garage?
Because in modern finance, the garage door is often locked by a massive team of lawyers. Transparency is a huge hurdle. Think about hedge funds or really secretive private strategies.
Oh, right.
Their entire business model, their secret sauce, relies on the broader market not knowing what they are buying and selling.
Because if a multi-billion-dollar fund discloses their holdings every day, other traders will just front row. They'll buy the stocks just before the big fund does, driving the price up and effectively stealing their alpha.
Yes. Or they'll just copy the portfolio for free without paying the manager's fees. Why pay 2% a year if you can just clone their trades?
Wow, yeah. So the manager refuses to provide the holding data.
Exactly. They say, you can have my monthly return numbers, but you absolutely cannot see my individual trades. So the allocator is forced to rely on returns-based style analysis.
Let's play out a scenario where this lie detector catches someone. Let's say you're an allocator. A manager comes into your office and pitches themselves as a highly conservative, value-driven investor. They say, we buy boring, safe, undervalued companies.
Right, a safe pair of hands.
You can't see their holdings, so you run an RBSA on their monthly returns.
And the statistical regression reveals that their returns perfectly mirror a highly volatile, aggressive, speculative tech index.
The shadow on the wall looks exactly like a Ferrari, but they are swearing to you up and down they're driving a Volvo. What do you actually do with that information?
You immediately confront them in the due diligence meeting. And this isn't just theoretical, by the way. This happens constantly in reality. It's called style drift.
Style drift. Okay, what causes that?
A manager might genuinely start as a value investor, but maybe value stocks underperform for 3 straight years. The manager gets nervous about their career risk, so they quietly start sneaking aggressive, high-growth tech stocks into the portfolio to artificially boost their returns and save their job.
Wow. And without that statistical regression, the investor would have absolutely no idea that their risk profile had fundamentally changed until a market crash wiped them out.
Precisely. You thought you were holding a defensive shield, and you were actually holding a highly leveraged spear.
Okay, so we've verified their style. We know their shadow matches their engine. Now we need to see how they handle the literal ups and downs of the market. Because, let's be honest, finding a manager who makes money when the whole market is going up is easy.
A rising tide lifts all boats.
Exactly. Finding a manager who protects your money when the market is crashing, that is the real trick.
And this brings us to the metrics of capture ratios and drawdowns. This is how we mathematically measure if a manager's performance profile actually fits your specific risk tolerance.
I really want to ground this math in reality, because the text can get a bit abstract. Let's imagine we have a $10 million portfolio. Let's start with the upside capture ratio, the UC. This measures how the manager performs when the benchmark index has a positive return.
Right. If the overall market goes up, how much of that up did your manager actually capture? If the UC is greater than 100%, it means they outperformed the market during the good times.
And conversely, we have the downside capture ratio, the DC. This measures how they perform when the benchmark has a negative return. But here the goal reverses. You want a number less than 100%.
Right, because if the market drops 10% and your manager only drops 8%, their downside capture is 80%. They only felt 80% of the pain.
Okay, let's look at the ultimate metric the text provides, the capture ratio calculation. You calculate this by dividing the upside capture by the downside capture. A final ratio greater than 1 means the manager participates more in rising markets than in falling ones.
Let's walk through this specific quiz example from the source material, but let's translate it into actual dollars for our $10 million portfolio, just so we can feel what these percentages mean.
I love that. Okay, we have a manager. Let's look at an up market first. The benchmark index goes up 3%. On $10 million, a standard index fund would make you $300,000. But our active manager earns 4%. They make you $400,000.
So we calculate the upside capture. We take the manager's return of 4% and divide it by the benchmark's 3%. That gives us an upside capture of 133.3%.
So they captured all the market's gains plus an extra third.
Exactly. Okay, now the down market. The benchmark crashes. It drops negative 8%. An index fund would lose you $800,000. But our manager's portfolio only drops negative 4%. They only lose $400,000.
We calculate the downside capture. The manager's loss of negative 4% divided by the benchmark's negative 8%. The downside capture is exactly 50%.
Yes.
Wait, let me pause here. How did they actually achieve a 50% downside capture? Are they just, holding half the portfolio in cash?
I mean, that's one way, but a pretty crude one. More likely, they are holding defensive stocks companies that sell toothpaste and groceries, things people buy even in a deep recession. Or perhaps they have active hedges, like put options that increase in value when the market falls, offsetting the losses in their stock portfolio.
Okay, so back to the final math. To get the overall capture ratio, we take our upside capture of 133.3% and divide it by our downside capture of 50%. That equals 2.67. What does that number actually mean for my $10 million?
It means you have found the holy grail of active management. A capture ratio of 2.67 mathematically proves that the manager is giving you significantly more of the good times while shielding you from half of the bad times.
I visualize this like a car suspension system. You want the engine to be powerful enough that you feel the smooth, fast straightaways. That's your 133% upside capture.
Right.
But you want the shocks to be incredibly responsive so they absorb the violent impact of the deep potholes. That's your 50% downside capture. A ratio of 2.67 means you are riding in a luxury vehicle on a dirt road.
That is a brilliant way to look at it. And you desperately need that suspension system because of the next major concept that text addresses: drawdowns. A drawdown is defined as a decline in value from a historical peak.
The text mentions maximum drawdown, which is the largest peak-to-trough loss. So if my $10 million portfolio drops to $6 million, my maximum drawdown is 40%. It's a measure of absolute worst-case scenario pain.
But the text pairs that with a metric that I would argue is even more vital: drawdown duration. This is the total time from the start of the loss to the exact moment the portfolio fully recovers back to its previous peak.
Okay, I really want to spend a minute on this, because drawdown duration isn't just a math problem, it is a psychological prison.
It absolutely is. Imagine a 40% maximum drawdown that happens during a terrifying flash crash. The market panics. You lose $4 million in 3 days.
Just gut-wrenching.
But the market realizes it overreacted, and by the end of the month, your portfolio is back to $10 million. The maximum drawdown was severe, but the duration was incredibly brief. The pain is intense, but short-lived.
Now contrast that with a long drawdown duration. Imagine you invest your $10 million. The market slowly turns against your manager's specific strategy. Over a year, your account bleeds down 20%, and then it just stays there.
Yeah, flat lines.
For the next 5 years, every single time you open your monthly statement, you have less money than you started with.
5 years of feeling like a total failure. 5 years of your board of directors calling you into meetings and demanding to know why you haven't fired this manager yet.
You are sitting there defending a guy who has been losing money since the Obama administration.
That is the true agony of drawdown duration. Even if the manager eventually recovers in year 6 and proves their strategy was mathematically sound all along, almost zero human beings have the psychological fortitude to endure a 5-year drawdown duration.
No one can stomach that.
Exactly. At year 4, you will capitulate, fire the manager, and pull your money out at the absolute bottom. So when you evaluate a manager's history, you can't just ask, how much did you lose? You must ask, how many years will you force me to wait to get back to even?
Which perfectly frames our next question. We've looked at the shadow on the wall, we've measured their suspension system, we've quantified the duration of their pain. But what is the actual engine driving all of this? How is the manager actually making these decisions? This brings us to the mind of the manager, their fundamental belief system about how the world works.
Right, and the CFA text divides all managers into 2 broad philosophical camps: passive strategies and active strategies.
Passive strategies are straightforward. They are based on the belief that markets are fundamentally efficient. The manager looks at the stock market and says, all known public information is already perfectly priced into these stocks. I am not smart enough to outwit the collective wisdom of millions of supercomputers and analysts. So they don't even try to beat the market. They just buy the whole index and match it.
And by doing so, they only earn risk premiums based on bearing what is called systematic risk.
Systematic risk, okay.
Systematic risk is the unavoidable baseline risk of being in the market at all things like global recessions, wars, or unexpected interest rate hikes. You cannot diversify it away. You simply get paid a historical premium for having the courage to keep your money in the market.
But then we have the active strategies. These managers fundamentally reject the efficient market hypothesis. They look at the market and say, people are emotional, algorithms overreact, laws create weird loopholes, and prices are frequently wrong. And I can exploit that.
Exactly. Active managers willingly bear that baseline systematic risk, but they also intentionally take on unsystematic risk to generate their alpha.
Unsystematic risk is the risk tied to a specific bet, right?
Yes. The risk that a single CEO commits fraud or a single tech product totally fails. They take on this highly concentrated risk because they believe they have an informational or analytical edge.
And the text gets incredibly specific here. It says active managers exploit 2 main types of inefficiencies to get this edge: behavioral inefficiencies and structural inefficiencies. Let's dive deep into these because this is where the actual money is made.
Well, behavioral inefficiencies are driven by human psychology. They are usually short-term mispricings caused by the biases, emotions, and irrational actions of other investors.
Like panic selling.
Exactly. Panic selling during a crisis or euphoric bubble-driven buying during a massive tech boom.
You know, I was thinking about this earlier, and the irony here is just profound. To make money as an active manager exploiting behavioral inefficiencies, you actually need other people to act like idiots.
Oh, absolutely.
Your entire business model requires the broader market to occasionally lose its collective mind.
It is a dark truth of active management. If tomorrow, every retail investor and institutional trader suddenly became a perfectly rational, long-term, emotionless, calculating machine,
They'd be out of a job.
a huge subset of active managers would immediately go bankrupt. They feed on fear and greed.
Give me a concrete example of how they capture that.
Let's say a highly profitable, incredibly stable company reports their quarterly earnings, and they miss their revenue target by exactly 1 penny per share. It's a total rounding error in the grand scheme of their business.
Right, meaningless.
But the market's algorithms overreact, retail investors see a red headline on their phone and completely panic, and they dump the stock. The price crashes 15% in 10 minutes.
Oh.
The active manager steps in, runs the math, realizes the intrinsic value of the company hasn't changed at all, and buys massive amounts of the stock at a 15% discount. They are directly monetizing the irrational panic of others.
Okay, so that's behavioral. Short-term, emotional overreactions. What about structural inefficiencies? The text says these are longer term, and they are caused by laws, mandates, and regulations.
Structural inefficiencies are fascinating because they are entirely devoid of emotion. They are forced actions. The market isn't panicking. The market is just handcuffed by its own rules.
Walk me through a scenario. How does a rule create an opportunity for someone else to make money?
Let's take the bond market. Imagine a massive, multi-billion-dollar institutional pension fund. Their internal charter and federal regulations strictly mandate that they are only legally allowed to hold investment-grade bonds.
Okay, strict boundary, investment grade only.
It is literally illegal for them to hold risky junk bonds. Now imagine a massive, stable, blue-chip corporation goes through a slight rough patch, and a rating agency downgrades their debt by one single notch.
Oh, I see where this is going.
That downgrade pushes the bond from the absolute lowest rung of investment grade down to the highest rung of junk.
The pension fund's hands are tied.
Exactly. It does not matter if the pension fund manager has done the research and absolutely knows the company will pay them back. It does not matter if they really want to keep the bond. The regulations force them to sell it immediately.
They have no choice.
None. Now, multiply that by 50 different pension funds all holding that exact same bond, all forced to sell it on the exact same day.
A massive tidal wave of supply hits the market all at once, with absolutely no natural buyers. So the price of the bond plummets well below its actual economic value.
That is a structural inefficiency. An active manager who isn't bound by those strict pension rules can step in, buy those artificially cheap bonds from the forced sellers, and just wait for the price to recover to its fair value.
That makes so much sense. It's not about outsmarting people. It's about providing liquidity to people who are legally forced to do something stupid.
Precisely. And the text makes a critical point here regarding your due diligence. If a manager cannot clearly articulate to you which philosophy they are pursuing, are they exploiting behavioral panics or structural rules, they probably do not actually have a real edge. The text defines this as signal creation versus signal capture.
Signal creation being the idea generation, how you view the world differently than the efficient market.
Right. If you don't have a clear philosophy, you can't create a reliable signal. You're just guessing.
Okay, so let's zoom out and say we've done it. We've gone through the whole gauntlet. We love the manager. We love their structural philosophy. We've verified their shadow with style analysis. Their capture ratio is a beautiful 2.67, and we are ready to invest our $10 million. How do we actually hand them the money?
This brings us to the delivery mechanism, the actual structural vessel that holds your assets. The text outlines two main options for institutional investors: pooled vehicles and separately managed accounts, commonly known as SMAs.
Pooled vehicles are what most people are familiar with.
Yeah.
Mutual funds, ETFs, standard hedge funds. The imagery is right in the name. It's a giant pool. All the investor funds, your 10 million, my 10 million, the pension fund's 100 million, are thrown into one massive pot.
Right, all mixed together.
The manager just trades the pot. There is zero customization.
It is incredibly efficient for the manager, but for you, the investor, it means you own a proportional share of the whole. You inherit all the embedded tax liabilities of the pool, and you are entirely locked into whatever strategy the manager applies to everyone.
I always compare a pooled vehicle to taking a public bus.
Right.
It gets you where you're going, it's cost effective, but you are on a fixed route. You have absolutely no control over the stops. You have to get off where everyone else gets off.
That's a perfect visual. The alternative, then, is the separately managed account, the SMA. In an SMA, your $10 million is held in a distinct, segregated account strictly in your name. The manager directs the trades, but you actually own the underlying shares directly.
It's hiring a private chauffeur instead of taking the bus.
Yeah.
And the pros of this seem overwhelming. The text notes massive tax advantages. Because you own the actual shares, your accountant can look at the SMA and harvest specific tax losses tailored entirely to your personal tax bracket. Plus, you get real-time transparency.
Yes, total visibility.
You can open the hood of the car whenever you want and see every single stock they're holding today.
It is the ultimate luxury in asset management. It provides total control and ultimate transparency.
But, and it's a big but, the text includes a massive warning label here. It introduces a concept called micromanagement risk. And this is where the psychology of wealth completely collides with investment theory.
It is a profound irony in finance. Wealthy
Yeah.
individuals and institutional boards demand SMAs because they absolutely crave control and transparency. But that exact transparency is often the very thing that destroys the alpha they hired the manager to generate in the first place.
Explain how that happens. Give me a story of how a client ruins their own SMA.
Let's say you hire a brilliant value manager who specializes in buying deeply distressed assets companies going through messy bankruptcies that have hidden value. You give them your $10 million in an SMA.
Okay.
The manager buys $1 million of a stock that is currently being roasted in the financial press, but the manager's deep quantitative research shows it's actually a gold mine.
Okay, the manager's doing exactly what I hired them to do.
But you, the client, log into your SMA portal on a Tuesday morning. You see this plunging stock sitting in your account. You read the terrible headlines, you completely panic, you pick up the phone, call the manager, and demand they sell it immediately because you don't want the headline risk associated with your name.
Wow. The client is basically grabbing the steering wheel from the chauffeur while the car is moving.
Exactly. Or consider a risk management scenario. The manager puts on a complex, expensive hedge, maybe buying put options, to protect your portfolio from a potential market crash. But the market goes up instead.
Which is good for the portfolio overall.
Right, but those put options bleed money. You log in, see a line item that is constantly losing money, and you veto the hedging strategy. You force them to close it, not understanding that a hedge inherently requires sacrificing some return for protection. It's like canceling your car insurance because you didn't get into a crash this month.
So by forcing the manager to cater to the investor's emotional comfort, it becomes completely impossible to judge the manager's true skill. You aren't getting the manager's brilliant strategy anymore. You are getting a watered-down, committee-approved, emotionally safe version of it.
Yes, trend chasing, panic selling, vetoing unfamiliar assets. When a board committee can see real-time data, every single monthly meeting devolves into an interrogation of the manager's short-term trades, rather than a patient evaluation of their long-term qualitative process.
Okay, so let's assume we are highly disciplined. We give them the SMA, but we tie our own hands. We promise not to grab the steering wheel. We let the chauffeur drive. This brings us to the final and often most contentious part of manager selection: the price of alpha, contracts and fees.
This is where the math meets the concept of alignment of interests. The text categorizes fee structures into two broad buckets: management fees and incentive fees.
Management fees are simple to understand. It's a fixed percentage based on the assets under management. Let's use real numbers again.
Yeah.
You give a manager $100 million. They charge a 1% flat management fee. They take $1 million a year, every single year, regardless of whether they make you a fortune or lose half your money.
Right, and the crucial point the CFA text makes about fixed management fees is their statistical impact on your returns. A fixed fee lowers your net return, obviously, but it has no impact whatsoever on the standard deviation of your returns.
Meaning the volatility of the portfolio remains exactly the same. If the returns bounce around wildly, they still bounce around wildly. The whole graph is just shifted downward by $1 million.
Precisely. But then we introduce incentive fees, also known as performance fees. These are charged as a percentage of the actual profits generated. If they make you money, they take a cut of the upside.
And this is where the math does something highly counterintuitive. The text states that an incentive fee actually lowers the standard deviation of returns for the investor.
Yes, it does.
Wait, slow down. Why does paying a manager a fee based on their performance magically make my returns less volatile?
Because under a performance fee, the manager is now mathematically sharing the risk with you. They're sharing the net gains, but implicitly they're also absorbing a portion of the net losses relative to what they would have been paid under a flat fee.
I see. During a massive bull market year, they take a big cut of the upside, which smooths out the top peak of your return curve. But during a terrible bear market year, they take zero incentive fee, meaning your downside is cushioned compared to a fixed fee structure where they take their $1 million no matter what.
Yes, exactly.
So paying a higher performance fee might actually be less risky for an investor than paying a flat management fee, because the manager's own wallet is absorbing a portion of the portfolio's volatility.
Exactly. It aligns the interests of the manager and the client perfectly. You suffer together and you prosper together. The text outlines three basic forms of performance-based fees, but it really drills down into structures that offer collars of bonus with limited upside and limited downside.
Let's walk through the specific deep dive fee calculation provided in the source material, because seeing the actual dollars makes this click. We are going to look at a complex performance-based fee schedule. Let's imagine you are investing $100 million.
All right, let's lay out the parameters of the contract. First, the text establishes a benchmark standard fee. If you weren't doing a performance structure, you would just pay a flat 0.50%. On $100 million, that's $500,000 a year.
Okay, $500,000 is our baseline expectation, but we are doing a performance contract, so what is the absolute minimum the manager can make?
The contract sets a base fee of 0.25%. That is the floor. No matter how badly they perform, they keep the lights on with 0.25%. On $100 million, that is $250,000.
Got it. Base fee is $250,000.
Next is the sharing rate. This is set at 20%. The manager gets to keep 20% of the active return they generate beyond the base fee.
Okay, 20% sharing.
Then we have the break-in active return. This is set at 1.50%. This is the target they need to hit for the performance fee to exactly equal what the old flat fee would have been. And finally, to protect the client, there is a maximum annual fee cap set at 0.75%.
Okay, so the fee is collared. It can never drop below $250,000, which is the 0.25% base, and it can never exceed $750,000, which is the 0.75% cap. It's limited downside, limited upside. Let's run a scenario. Let's say the manager hits exactly that break-in active return of 1.50%. They generate $1.5 million in excess profit for you. What is their fee?
Let's do the math exactly as the text structures it. They get their base fee of 0.25%, which is $250,000. Then they get their sharing portion. The sharing is 20% of the active return. The active return is 1.50%. So 20% of 1.50% is 0.30%. On $100 million, that's $300,000.
Wait, hold on. If I add the base fee of 0.25% and the sharing portion of 0.30%, I get a total fee of 0.55%. But the text explicitly states that at a 1.50% active return, the fee is exactly 0.50%. Where's the discrepancy?
This is a brilliant nuance in how these contracts are actually written. The text is illustrating a schedule where the sharing applies to the return above a certain hurdle, or the formula adjusts to perfectly hit that break-even point. Let's reverse engineer the text logic. The break-even point of 1.50% is designed to be the exact point where the performance fee matches the standard flat fee of 0.50%.
Okay, so the total fee must equal $500,000.
Right. If the total fee is 0.50% and the base fee is 0.25%, the performance portion must be the remaining 0.25%. If the sharing rate is 20%, what number is 0.25%? 20%. It is 1.25%.
So the sharing rate of 20% applies to 1.25% of the return, generating the 0.25% bonus. Add that to the 0.25% base, and you hit exactly 0.50%. The key takeaway for you listening from this table isn't the complex algebra, it's the symmetry of the design. If the manager generates $1.5 million in active return, they bill you $500,000, leaving you, the investor, with a net active gain of $1 million.
Exactly. It's a structured win-win. Now let's look at the extremes. What if the manager has an absolutely spectacular lottery ticket year? They return 5% active return. They make you $5 million in excess profit.
Without a cap, they would take 20% of that $5 million plus their base fee. They would walk away with millions. But because we negotiated that maximum annual fee cap of 0.75%, the fee hard stops right there. The manager gets $750,000, and you, the investor, keep all the remaining millions.
That cap is vital. It protects the investor from paying astronomical fees during a fluke rising tide bull market where every stock goes up and the manager just got lucky. It prevents a type I error from draining the fund through exorbitant fees.
And what about the bad years? What if the active return is zero, or even negative? The manager loses you money.
The sharing portion drops to zero. The manager only collects the minimum base fee of 0.25% or $250,000. They suffer alongside you, earning half of what their standard flat fee would have been.
It is a brilliantly designed mechanism. You give the manager an incentive to swing for the fences to get their sharing bonus, but the cap keeps them from taking reckless, bet-the-farm risks, and the low base fee punishes them for underperforming.
It forces the manager to focus on repeatable, risk-adjusted skill. It filters out the gamblers, which brings us all the way back to the very first thing we discussed, the core purpose of due diligence.
It really does. Everything connects. Let's recap this incredible journey we've taken through this CFA material. We started by moving past the illusion of pure returns, conducting rigorous, qualitative due diligence to make sure we are evaluating the process, the kitchen, and not just the Yelp reviews.
We explored the intense psychological minefield of type 1 and type 2 errors. We put ourselves in the boardroom to understand why institutional committees are paralyzed by the fear of highly visible mistakes and how that fear leads to the invisible bleed of missed opportunities.
We ran the lie detector test of style analysis. We learned why we often have to settle for the statistical shadow of returns-based analysis, but why opening the hood with holdings-based analysis is the ultimate goal.
We measured the suspension system using capture ratios, proving mathematically how to get more of the upside and less of the downside. And we felt the psychological agony of drawdown duration staring at a losing statement for 5 straight years.
We analyzed the mind of the manager, understanding the profound irony that active managers exploiting behavioral inefficiencies actually rely on the rest of the market acting irrationally.
We debated the delivery mechanism, balancing the massive tax and transparency advantages of a separately managed account against the very real, very human danger of micromanagement risk.
And finally, we locked it all in with a performance-based fee structure that literally lowers portfolio volatility by aligning the manager's wallet directly with our own.
It is a comprehensive, bulletproof framework, and the beauty of it is its universality. Whether you are a retail investor staring at a list of mutual funds for your IRA, or you are the chief investment officer of a sovereign wealth fund, these principles apply. Avoiding errors of commission, understanding capture ratios, aligning incentives, these are the universal laws of capital allocation.
They truly are.
Yeah.
But I want to leave you, the listener, with a provocative final thought, building on everything we've discussed today about quantitative versus qualitative analysis. Think about the sheer speed of technological advancement. As artificial intelligence gets exponentially better at processing massive, unimaginably large data sets.
Oh, it's moving so fast.
Right. As AI masters the statistical regressions of returns-based style analysis in mere milliseconds, the quantitative side of this process will soon be entirely commoditized by machines. So the question becomes, will the entirely human qualitative assessment of a manager's psychology, their adaptability, and their behavioral edge become the only true way to find an advantage in the future? When machines can parse all the numbers perfectly, is human intuition the last remaining alpha?
That is the defining question for the next decade of finance. The math will be perfect, but the humans will still be human.
Something for you to ponder the next time you look at your portfolio. Thank you for joining us on this deep dive.